value chain finance, agricultural value chain finance, defines business as a process, as a chain of specific integrated units. The key concept here is that they are integrated units. It's not one single activity or an individual borrower, as in the traditional approach, but it is a integrated units process. Number two, it recognizes interactions of small-scale producers and SMEs and with larger domestic and foreign firms. It's important to include here this big picture approach, this big picture perspective, not just lending to one individual, but throughout the value chain. And number three, agricultural value chain finance is a demand-driven activity. It reacts to market forces, responding very specific needs for financial products at any point in the chain, as we have seen in our description. So there is two market responses, very clearly differentiated in terms of how to deal with the supply side of the equation. Now, we have on the traditional agricultural credit a supply-driven approach. We are going to provide finance in order to increase production, therefore supply, and the market will follow whatever we produce and offer to the market. Whereas value chain, agricultural value chain finance, it is demand-focused, responds to real market demands. Because we are addressing transactions here, we're not just going to provide funding for increase in supply. We are going to do that to satisfy a real market demand. And by real market demand, it's not just a need. It's a need plus a willingness to pay. It's a need backed up with resources which will lead us to transactions. So, having said that, we're going to see the third part of this presentation, in which we are going to describe contract-based collateral lending and blended finance as instruments for inclusive, sustainable, and resilient value chains and food systems. Now, this is very much related to our integrated agri-food system initiative, which pretty much defines two drivers of change: value chains and market interventions. So these are the two key drivers which we're going to use to employ in building this inclusive, sustainable, and resilient value chain value chains, agri-value chains, and food systems. We have to start from getting a very clear picture that classic microloans, which were very active, which are indeed very active in rural areas, do not actually meet financial smallholders or agricultural SMEs demands. Why? Because amounts could be not the ones they require, and short-term lending could not actually fulfill the real demands of these segments. They do not, number one, adjust themselves to the process, to the production process of agricultural value chains. And number two, costs in terms of interest rates could be too high. So classic microloans do not meet financial needs of smallholders. And we have seen that traditional lending is also unsuitable due to, number one, lack of collateral on the demand side, on the producer side, and high transaction costs and risks perceived or incurred by the bank. So there's two big mismatches here in terms of microloans and traditional lending. Okay, what we have now left here is adopted structured financial products as the ones we call contract-based or cash flow-based. Number one, purchase order finance, contract farming, and we're going to see a third one, which is blended finance, which can facilitate access to finance by small holders and agricultural SMEs. Number one, purchase order finance. Now, this is transaction-based credit, very specific. It's not a general line of credit or loan. Trade finance is short-term working capital loan in terms of an advance to fill orders, contract, or pre-shipment finance. The term maturity of the purchase order loan matches with the term maturity of the purchase order contract. So if we have a product process which is 4 months or 3 months or 6 months, that's exactly the maturity of our lending, of our borrowing, if you like. That's good because we're not going to pay interest to the financial institutions any longer than what we need. And number two, the financial institution is not going to have any more risks, they call it exposure, as necessary. So if we structure this very well, it becomes a self-liquidating loan. How does it work? It's very simple. A buyer emits a purchase order to the seller, which in this case is an agricultural producer or an association or a cooperative or an SME. And once they got this good, verifiable, legitimate purchase order contract, if you like, the seller goes to the bank and receives this approval. We're going to go in some more detail about this, and transfer the account receivable to from the buyer to the financial institution. The bank, the financial institutions lend the seller delivers the product, and very often the buyer collects this funding. So how it actually works. Number one, producer obtains a verified purchase order finance from the buyer, the customer, for a specific product. Now the producer estimates costs, direct costs, takes out profits, takes out all other non-direct costs, which eventually leads to typically it is about 60-65% of the required financing of the total purchase order, which is required for finance. Then the bank reviews the purchase order. It verifies the cost breakdown and conducts a good analysis of both producers and buyers. If this loan is approved, the bank disburses the funds to the producer or to the supplier if they want to really have a better risk management, and the accounts receivable of this purchase order is assigned to the bank. So the producer actually delivers the product at the end and invoices to the buyer, and the buyer pays to the bank directly. The bank receives this payment from the buyer, that's all cost advanced from the financing, and remits the balance to the producer and seller. Now, this is very simple, but at the very heart of this lies this cash flow of the entire transaction. We have to be very, very keen in terms of provide technical assistance to the demand side, and in this case, the sellers, in terms of building credible, verifiable cash flows, because this is essentially transaction-based. It's not collateral-based. So at the very, very heart of this lending, of this credit, it is very much the cash flow viability of this. Number two, contract farming. Now, farming contracts, as well as purchase orders are binding agreements. Now, this involves producers and anchor firms through which farmers or groups of farmers ensure supply of products to individual or anchor or lead firms. Okay. Now, these contracts legally entail sellers, farmers, obligation to supply volumes and quantities and qualities very well specified in the contract, and the buyer's obligation to offtake and pay once it's delivered. Now, very often buyers, that means the anchor firms, provide inputs like seeds, fertilizers, plant protection, so on and so forth. And if they agree, some collateral to a financial institutions, thereby securing their inputs and supply chain. Now, you may say, oh, well, but prices could change. Well, best practice is advised to include price fluctuations provisions to balance both parties' market changes and sharing potential risks and benefits in terms of or losses if this is the case. Now, I have seen this in terms of having this price fluctuation clause in which if there's an increase of 10%, well, this is going to affect the buyer. I mean, the buyer only 5%, and it's going to benefit the seller only 5%. You know, there is agreements that actually can avoid side selling because of price fluctuations. Now, for the banks, this is very interesting because this contract, this verifiable contract, the same as in purchase order finance, replace traditional collateral requirements. So this opens new opportunities for lending and to generate a more inclusive agricultural finance model. If you like, to see this in a picture, you can see it like this. It is essentially a contract farming in which you find these anchor leading firms having these contracts with the producers and the producers associations, which provide with the inputs for the anchor firm in terms of quantity and qualities, and they assure their supply of inputs. And eventually they sell this. So what is this is so interesting? It's because we can actually find and promote and facilitate multi-year contract farmings or purchase order agreements, which will facilitate the process of accessing to midterm lending. Midterm lending is absolutely key for the activity, for instance, we have in terms of mechanization, as the activity we have now in terms of harnessing appropriate scale of farm mechanization in Zimbabwe, our Hafiz activity there. If we're able to put this, to express this multi-year contracts in terms of cash flow, we can identify clearly a source of repayment. We have to develop a good, credible cash flow lending activity in order to actually bring these three parties together. And this allows producers to access to new technologies, new green technologies in this case, for instance, inputs, process generating win-win situation and measurable triple bottom line impacts. Something very interesting about this is that we can actually develop a longer term activities to finance the entire sustainability of the value chain. We'll check this with an example later on. Now, the third one is blended finance. And blended finance, essentially, what it does is mobilizing and align a variety of financial flows and non-financial services. This includes, of course, an efficient use of public financial resources and private investments, taking opportunities which otherwise they wouldn't invest or take. Now, blended finance structures different types of sources, could be private, public, and different types of these resources, concessional or non-concessional or just commercial, to mobilize funds for development purposes. Blended finance creates solutions in terms of de-risking or lowering costs or providing liquidities to the specific value chains, which if we do not address, they will not facilitate private investment in agri-chains. In ag value chains, essentially in food and ag blended finance transactions, usually these resources are deployed with three purposes. Number one is de-risking. Number two is reducing transaction costs. And number three is addressing the insufficient returns on investments that often prevail in parts of the value chain. That means low returns. Let me describe, just list some of the blended finance instruments available for doing this. Number one, loan investment guarantees. This is very popular. We know that there are some very interesting, essentially loan guarantees provided very often, most of the cases, by state-owned banks or institutions. There's a first loss schemes, outcome funding, concessional debt equity, subordinated debt, it's called mezzanine finance, impact-linked finance, impact bonds, so on and so forth. I wouldn't like to get much into this because we still have some material to cover, and there's some descriptions here in the presentation. But essentially, what we want to do here is increase these urban-rural synergies throughout the agri-food value chain. Essentially, we have to build a smart system of positive economic incentives in order to bring additional resources from the private sector to crowd in this development investment. Excuse me. So what can we do about this now? We have seen that our integrated agri-food system initiative describes this new role as innovation brokers. Now, CIMMYT is in a unique position to generate the highest level of credibility among the different actors of the value chains. As a global center of scientific research and technology generation, we are in an ideal catalytic position for sustainability of agribusiness chains and financial inclusion processes. So we can actually do a lot of good high impact activities in terms of, number one, bringing inclusive, sustainable, and resilient food systems. So what are we doing now? As we talk here in Mexico, we are dealing with this Walmart Foundation. We are drawing a very interesting proposal, which essentially will include female producers in some areas of the country. Now, how could this work? How would this work? We will have a buyer and confirm that signs a contract with producer that includes quantities, and all the technical details about this supply chain. Now, with this contract, these producers go to the financial institutions and get the money for working capital to produce this. Eventually, the producer will sell and deliver the product according to the contract, and this anchor firm, which is associated to this effort, will buy from these producers and eventually sell to their wholesalers, retailers, and consumers. And they could also pay directly to the financial institution if this is the agreement, or just allow the producers to pay themselves to these financial institutions. Now, we can actually also include concessional finance for the financial institution to own land to the producers, and loan guarantees. This could be a model for sustainable and resilient financial inclusion, which will be very interesting to do. What can we do actually? What can we do from my very office is providing, number two, technical assistance to the financial institution and financial education to the producers and producers associations is needed. Number two, this is another idea we have here, another initiative for this contract farming finance for sustainable and resilient financial inclusion. We have a major corporate partner here, again, issuing these contracts with these producers associations in order to green and provide sustainability to their value chain. And then again, producers take this contract, go to the financial institution for lending, they access to the resources, essentially based upon the quality of this contract. So they produce in the specific terms the strategic partner wants to get these products done. They sell it. This big brewery anchor firm buys it and then generates this new type of products, which are produced according to the new standards, if you like. Then again, we have concessional finance, financial to the financial institutions, enhanced with loan guarantees, so they can have reasonable comfort for lending to these new clients under these new conditions. What can we do? We can provide technical assistance to financial institutions in terms of product development, as well as to the producers in terms of financial education and financial management. And of course, we know what sustainability is all about. We can generate a lot of impacts in terms of measurable and certifiable science-based results and impacts. So that's in essence what we are thinking, what we believe financial value chain finance could help us to achieve our ends and results. Conclusions. Very quickly, agricultural value chain finance circumvents and solves the main challenges of the traditional agricultural finance model we described before. It is not a financial product, but an inclusive approach. It's a strategy. Ag value chain defines business as a process. It's integrated units. It integrated productions, chain approaches with the development of financial products to develop value chain. All points. We have to develop this value chain in all points because we have the right products to do this. We build value chains in terms of real economic relations, transactions, that is, between sellers and buyers. It reduces transaction costs, uses non-traditional collaterals, and reduces information asymmetries. Successful ag value chains create value for each of the members. using positive economic incentives. Ag value chains finance are market-oriented, sustained by demand, not subsidies, and supported by existing infrastructure. Can I just wait until things change? We just have to work with what we have. Ag value chain works only when there are real market opportunities and where there is real deficits in lending and credit for supply in the chain. Properly structured, purchaser finance, contract farming finance, and blended finance can facilitate structuring an inclusive, sustainable, and resilient value chains and thereby food systems. And it's very consistent with our integrated agri-food system initiatives. Now, a final recommendation. Whenever we are going to address financial interventions, if we want this to be successful, we have to make them sustainable and profitable as they recover all the costs incurred in this and generate a profit margin or and surplus for the financial institution. Number two, it should be scalable. We can really expand or adjust downwards, downscale, if it's not the case that we are not getting response from the market, and should be replicable in terms of this experience can be reproduced throughout any country or region as many times as considered necessary, involving different types of financial institutions and value chain. Scalability is key for this. If we have a good reading of our demand, then we could have higher, better, scalable results. So therefore, being this a demand-driven activity, having a good demand assessment and reading of our activity is crucial. Well, thank you very much. I thank you for your interest, and I'm open to hear your comments and your questions. Thanks a lot.
Thank you very much, Dr. Ortega, for your interesting presentation. We have two questions in the chat. I don't know if Dr. Moti can open your microphone, or do you want me to read it?
I can ask it.
Great.
Yep. Thank you, Ramiro. It's a really great presentation. My quick question is, the agricultural value chain financing is in a way inclusive for those farmers who are already in the semi-commercial or commercial production systems where their commodities are getting into the value chain. But my question is how the subsistence farmers, those who badly need credit, could be included in any of these kind of initiatives, or any financing options that you can recommend for that kind of farmers. Thank you.
Thank you very much for your question, Mori. That's a key question. I really appreciate this question. Subsistence farmers perhaps need some different type of technical assistance. Number one, I wouldn't recommend lending to a subsistence farmer because that could have very bad repercussions and impacts. Number two, subsistence farmers perhaps need a big jump in terms of productivity, of higher levels of production, because subsistence farmers perhaps need a good, smart subsidy to bring them out of the subsidy level into, and by the way, by doing this, incorporating them into commercially viable value chains would be the best way to go. But essentially, subsistence farmers may not be ready for these, and therefore they will need a different package of technical assistance and financial assistance in order to bring them into this value chain, viable commercially value chain finance. These are very specific cases we should look and address on very specific terms to see their viability and the way to move on to a more viable activity other than just subsistence farmers. That's a very critical question. Thank you very much for answering this, Moti.
Thank you very much. Dr. Srijana, sorry if I'm not pronounced correctly, but do you want to raise your question also? Open your microphone.
All right, thank you very much for a very productive and informative presentation. I'm from Nepal, working on this maize commercialization model. We've just started the initiative, and then we have a company that is interested in buying maize from the farmers. It's a feed mill. So the concept is linking the seed system to until the feed mills. And there are we're trying to link it up, but then there are no conducive policy or regulatory mechanisms or crop insurance systems. So there are a lot of high risks involved. So I was just wondering, what would be some of the examples from your past experience on how you try to support the initiative and make it successful via donor programs? Thank you.
Thank you very much, Dr. Srijana. Thank you very much for attending this all the way from Nepal. Well, that's a key question. I mean, this in a way, this works like a microfinance. Once they have this successful operation, they keep on doing more and more often and for a higher amounts. The key activity here is bringing this new pilot for both of the parties and being the honest broker. Yes, there are too many problems and perception of high risk from both sides. On the supply of finance side, if you have the availability of some type of loan guarantees or some type of other guarantees available, that would be great, because that provides real good comfort for the lending side. On the borrowing side, it is important to have a very, very good detailed cash flow and different scenarios for cash flow. So that would provide them, also comfort for borrowing this and actually conduct these transactions. I'm happy to know you are now into this facilitating stage, because that's really challenging and difficult. Essentially, when you are facilitating meeting these two parties to conduct this, essentially the main activity here is to align smart and positive economic incentives on both sides. That's critical, and for the financial institution, that they know they are doing well and they are doing good. That would be my take. Thank you very much, Dr. Srijana.
Thank you very much to both of you. I don't know if anyone else wants to raise your hand to make a question. We have to.
May I come again?
Left. Yes, sure. Go ahead.
Yep. On this contract farming related issue, and also what Srijana raised, who should bear actually the risk in market price changes after contracts are signed? If prices are increasing after contracts are signed, then that might lead the producers to side selling if the buyers are not adjusting the market price on the contract. and sometimes, the price might go down as well, and then the buyer might not be really ready to buy, and they abandon the purchase. So who should really bear the risk of such kind of things? I mean, does it go to the producer, the buyers, something in between that they share, or any transfer to a third party from your experience, Ramiro? Thank you.
Moti, thank you very much for your question. This is a critical question. A good structured contract farming should address this problem. And of course, I mean, this is a mutually agreed clause. For instance, if price increases, market price increases by 10%, the selling part should benefit by 5% and give up the other 5% in terms of market stability and assured payment. If prices go down by, again, 10%, it also should be included. If prices go down by 5%, still the buyer will buy on only 5% discount, not the full 10%. Now, side selling is a very rational decision. If we structure this transaction well, we can avoid side selling by providing these clauses in case of prices go up, in case of prices go down. Now, I'm just saying 5% as an indicator because that's a process in which both parties have to agree upon and negotiate upon. But any good contract farming should include a price changing, a meaningful price changing a provision to make it work. Otherwise, it just won't work. I have seen side selling essentially by very, very poor producers that they decided that they was the way to go because they didn't have any other chance. And these are very rational decisions, which should be included in any good working contract farming agreement.
Thank you.
Thank you very much. I think we are on time and we can continue with this conversation through email. Please feel free to contact Dr. Ortega at c.ortega@ceir.org. Thank you very much for your time.
Oh, dear colleagues, distinguished friends, I'll be more than happy to answer any question you have. Absolutely delighted. That's what I'm here for. And I will be really happy to receive your phone calls, Zoom conferences, or emails as you best find it possible to do. I will make available this presentation, and I really want to appreciate and express my appreciation, rather, and thank you all for attending this call. I'll be more than happy to provide you any information you need, any advice you require, or any other sources of information for your activities. Thank you very much again, and you guys have a great evening, great afternoon, and a nice day. Thank you.
Thank you very much. See you in the next seminars. Bye-bye.
Bye-bye.